Good evening, everyone. Welcome to the channel. Today I am going to talk about Conch Cement interim report. Do note that this is not a financial advice or a buy or sell call. All content are AI generated and is not associated with anyone. And unfortunately, I don't see any extracted summary provided. Please provide the summary so I can generate a quick read overview essay on what businesses and services the company is providing. The significant increase in Conch Cement stock price over the past year can be attributed to several key factors. Firstly, analyst upgrades and Chinese stimulus measures announced in October 2024 contributed to the growth, as analysts anticipated a boost in demand for cement due to government policies aimed at combating deflation. Additionally, improved supply-demand dynamics and infrastructure investments in early 2025 led to higher demand for cement, with the company's first quarter results showing a year-on-year bottom-line growth of over 20%. The strategic acquisition of assets from Yaobai Special Cement Limited in June 2025 further strengthened its market position and was seen as a bullish indicator. Finally, the cement industry's increased desire to maintain profits and the expectation of earlier-than-usual price hikes during the peak season drove gains in August 2025. Overall, these factors combined to drive Conch Cement's stock price up by over 41% in the past year. The primary drivers of revenue growth or decline in the company's financial performance can be summarized as follows. Revenue growth is primarily driven by strong sales performance in various regions, including East China, plus 6.04%, Central China, plus 7.19%, South China, plus 8.63%, and West China, plus 9.96%. Increase in selling prices of products, plus 2.31%, consolidation of the domestic cement industry market expansion of upstream and downstream industrial chains, development of consumer building materials. Revenue decline is primarily driven by decrease in revenue from clinker, minus 3.97%, and aggregate and manufactured sand, minus 2.98%, decrease in sales volume of cement and clinker trading business in overseas, minus 20%. These drivers indicate that the company's revenue growth is largely dependent on its domestic market performance, while revenue decline is primarily driven by external factors such as exchange rate fluctuations and decreased sales volumes in overseas markets. Net income and profit margins. A mixed picture. The financial summary reveals a mixed picture for net income and profit margins. On one hand, net income decreased by 4.3% period on period, indicating a decline in overall earnings. However, there were increases in various segments, including building materials, aggregate and manufactured sand, and commodity concrete. Profit margins also showed some variation. Gross profit margin decreased in minus 32.5 grade cement and clinker, but increased in other areas such as building material industry and aggregate and manufactured sand. Net income margin saw an increase in building material industry and aggregate and manufactured sand. The overall net income increase of RMB 169,771,000 was offset by the period-on-period decrease, resulting in a net decline of 4.3%. This mixed performance suggests that while some areas are performing well, others are experiencing challenges. The company's financial performance indicates a consistent generation of positive operating cash flow. The net cash flows generated from operating activities for both 2025 and 2024 are substantial, with amounts of RMB 8,286,544 and RMB 6,870,679 respectively for the 6 months ended June 30, 2025. This trend is also reflected in the year-end results, where net cash generated from operating activities was positive at RMB 7,985,026 in 2025 and RMB 6,430,077 in 2024. These figures demonstrate that the company's operations are generating sufficient cash to support its financial needs, indicating a strong foundation for future growth. The company's debt level and interest expenses have undergone significant changes. The total debt has decreased by 14.1% from last year, with long-term borrowings and non-current bank loans also experiencing a notable decline of 22.71% and 22.5%, respectively. This reduction in debt is expected to lead to lower interest expenses. In fact, interest expenses have been effectively reduced through foreign exchange arrangements and timely adjustments to fund management plans. Specifically, interest expense on financial liabilities has decreased by RMB 73,646, while interest on bank loans and other borrowings has decreased by RMB 74,403. The only notable increase is in interest expense on lease liabilities, which stands at RMB 678,000 in 2025 compared to RMB 0 in 2024. Overall, the company's efforts have resulted in a reduction of debt and corresponding decrease in interest expenses. The financial summary reveals a mixed performance across various segments and regions. Notably, Eastern China stood out as a top performer in both periods, boasting high revenue and profit margins. Central China also showed strong results, albeit slightly lower than Eastern China's. In contrast, Western China struggled with low revenue and profit in both periods. Overseas operations also underperformed, with relatively low profit and lower revenue from external customers compared to other regions. The Anhui region and unspecified areas lack explicit data, making it difficult to assess their performance. The company's management is emphasizing a multifaceted strategy to drive growth and expansion. Key initiatives include consolidating the domestic cement industry through mergers and acquisitions, accelerating overseas development, and extending industrial chains in aggregate projects and commodity concrete business. Additionally, the company is investing in new technologies, including digital and new energy solutions, with a focus on zero, low-carbon solutions. This comprehensive approach aims to enhance competitiveness, drive innovation, and position the company for long-term success. There were no notable acquisitions or divestitures reported in the financial summary. The company did not engage in any significant purchases or sales of assets, indicating a stable and conservative approach to its business operations. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. Notably, in 2024, the company paid out dividends at a rate of RMB 0.71 per share, while also allocating significant funds towards buying back shares for RMB 161,428,000. This commitment to shareholder value was continued into 2025 with an interim dividend payment of RMB 0.24 per share. Concerns about inventory buildup or supply chain disruption exist. The financial summary reveals signs of potential issues in the company's inventory management. The decrease in inventory turnover ratio by 10% year-over-year, YoY, on page 5 suggests that inventory is not being sold quickly enough, potentially leading to buildup. Furthermore, an increase in raw materials and finished goods on page 117 indicates a possible accumulation of stock. These indicators raise concerns about the company's ability to manage its inventory effectively, but there is no clear indication of supply chain disruption issues. That concludes the financial summary for Conch Cement. Feel free to comment below, and I will be happy to answer them when possible.